Hello everyone, today I'm going to talk about what is DTI and how to calculate it. Now, simply put, DTI is your debt to income ratio. Now lenders will use that metric to determine how well an individual manages their debt and also to pre-qualify someone for a home loan. Now you might also want to figure out how to calculate DTI simply for your own purposes of seeing, hey, you know what? I'm not quite ready to contact a lender to get pre-qualified for a home loan, but I just kind of want to see before I contact a lender how much of a home I can buy. So I'm going to show you how to do that calculation. Now I do recommend always getting pre-qualified for a home loan, but you might be so in your beginning phases of just deciding whether you want to buy a house and kind of just determining, hey, how much house can I buy? So, okay, fair enough. So now DTI we determine by first looking at your gross monthly income. So let's assume your yearly income is $100,000. You divide by 12, you get your gross monthly income of $8,333 for this example. And in this example, I've got your car payment, $600, student loan payment, $500, and a credit card payment of $100. So any type of installment loan or monthly payment you have on a car payment or credit cards is how you're going to itemize your monthly expenses. Now, I want to stress, it is your monthly payment, your recurring payment. So it's not your loan balance. So you might have a loan balance of maybe $20,000 on your car, but your monthly payment is about $600. So we've got those itemized, and then let's assume you're looking at a house and it's mortgage payment, total mortgage payment is going to be $1,500. So you add these items up, which are $1,200, with the mortgage payment of $1,500, and you get a total monthly expense of $2,700. So then what you do is, how do you figure out the DTI? You take that total monthly expense with your total gross monthly income and divide the $2,700 by the $8,333, and you get a debt to income ratio of 34.2%. Now, is that a good DTI? Well, it depends on what the lender's requirements are. How high does the lender allow you to go on DTI? What's your maximum? So for conventional loans, the average DTI is between 36 and 43%. There are lenders that will go higher to 50 to 57%. It depends on the loan product as well as the lender. And so, like for example, loan product meaning FHA, VA, conventional USDA loans, just different types of loan products. So let's assume for our purposes that we go to a lender that has a maximum DTI of 43%. So now, then how do we calculate the purchase price? What's the maximum purchase price we can go up to when we want to buy a house? So what you do is you go back and so the maximum DTI is 43%. You take 43% of your monthly gross income. That gives you the maximum monthly expense that you can have to meet that requirement. So, but that also includes a mortgage payment. So now, assuming that we do not have a mortgage yet, we're house hunting right now and we're looking for a house, so therefore we don't have a mortgage. So we want to know what's the maximum payment we can have and what's the highest purchase price we can have to buy a house. So what you do, you take again 43% of $8,333, which is your gross monthly income, gives you this number, $3,583, and you subtract your total monthly expenses. Remember, you don't have a mortgage yet. You're trying to figure out what's the maximum mortgage you can get. You subtract $1,200 from that total monthly expense based on that maximum DTI of 43%, and you get a maximum mortgage payment of $2,383. Okay, so now we know that that's the most we can afford our monthly payment to be based upon our other monthly expenses of $1,200. Okay, but how do we find out, again, what's the maximum purchase price? How much of a home can we purchase? Well, I'm going to show you. So we need to pull out a mortgage calculator and work backwards from the mortgage payment to figure out what that purchase price is going to be. So let's go to my computer. I'm going to show you online on how to exactly calculate that. All right. All right, so what we need is a mortgage calculator. So what we do is we go online and we search for mortgage calculator, and a whole bunch of them pop up. I like to use this one right here, which is with bankrate.com. It's very easy to use. It breaks it down into its basic elements. So now we know from what we did, the calculations we did on the whiteboard there, is that the maximum monthly payment we can have is $2,383. So what does that equate to in as far as maximum purchase price? Well, let's take a look at this calculator. So let's say we're looking for a house of about $500,000. That's my dream home. That's the one I want to purchase. So I punch in $500,000 in here, and I've got 20% down payment and to put down towards the purchase of the house, and we're looking for a 30-year fixed rate loan. That's a 30-year term, and using a 7% interest rate, which is the average interest rate right now as of this time. So with those parameters punched in, on the right side here we get the principal and interest payment of $2,661. So it's the monthly payment is broken down into basic elements: principal and interest, and property taxes are going to be $329. Homeowners insurance, that's for like fire and so forth, is $66 a month. And PMI, private mortgage insurance, well, since you're putting down 20% down payment towards the purchase of the house, you're not going to have PMI. It's going to be zero. If you put down less, then you could potentially have PMI. I do have a previous video that you can look up that discusses exactly what PMI is. So go ahead and take a look at that when you can. Now, we're going to assume that in the community that we're purchasing, there is no HOA. Therefore, there's the payment, the HOA fee is going to be zero. All right. So that gives us a total payment of $3,056 based on a purchase price of $500,000. That $3,056 is well above our number of $2,383, which is the maximum monthly payment that we can afford. So that means we cannot buy this $500,000 house. So let's play around with this a little bit and punch in, let's say, $375,000. Okay, $375,000 gives us a total monthly payment of $2,308, which is less than the $2,383 that we calculated that the maximum DTI 43% allows us. So we qualify for the $375,000 house. We got a little bit of wiggle room there. So let's just punch a higher number in there. So purchase price of $385,000. Okay, so that gives us a monthly payment of $2,368. Wow, that's pretty darn close. We're only off by $15. So essentially, we qualify for a maximum purchase of $385,000. Remember, based upon our other monthly expenses, the $1,200, the car payment, the student loan, and the credit card. Now we're adding the mortgage payment here. And so that combined is keeping us just barely below 43% maximum DTI. But you still want to buy that $500,000 house. That's your dream home. What do you do? All right, let's go back to the whiteboard. I will show you what you can do. All right, so you still want to purchase that $500,000 home, your dream home. So what can we do? Now, one of the things that we can do is decrease your debt or your monthly expenses. And maybe you can borrow some money from your parents, or if you end up getting a job raise or increasing your income somehow, that might be an option. So let's say it is. So let's say you can pay off your balance on your car, and it decreases your $600 to zero. And then let's say you can pay off the balance on your credit card as well. That, again, you get rid of $700 monthly expense. So that frees up some money for you. So the only other monthly expense you have other than the mortgage now is your student loan. So going back to our example, for your dream home, you've got a purchase price of $500,000, 20% down, 7% interest rate, your payment that we calculated online was $3,056. Now, your only other monthly expense is $500, the student loan. Add those together, we get this number, $3,556. Divide that by $8,333. Remember, that's how we calculate DTI, right? So, again, mortgage payment, your only other expense, the student loan, comes to $3,556. You divide that by your gross monthly income, gross meaning before taxes and any other obligations. So divide that number by your income and you get your DTI of 42.6%. So remember, this lender allows us to go up to a maximum of 43%. So therefore, you qualify. You qualify for your dream home. You can purchase that $500,000 house if you decrease some debt. Or, if you do come in with more income, that's another way, obviously, right? So you wouldn't have to pay off those debts. But I always recommend having as least amount of debt as possible. So there you have it. We've learned we learned what is DTI, how to calculate it, and how to calculate your maximum purchase price, whether you qualify for a loan. You can do that without even talking to a lender, but you kind of get an idea. Now, there are other guidelines for qualifying for a home loan. So when you are ready, you should contact a lender and get pre-qualified. But in the beginning phases, you can get an idea of how much a house you can qualify for. So if you've enjoyed this video, please give me a thumbs up, subscribe to my channel, leave some comments if you guys have any questions, and then I will see you folks next time.